guys, it's Stock Curry, and in today's video, I'm going to explain why the markets were down today, why I think we are going to get a Santa rally over the next 2 weeks, and just how bad it could get in 2022 if we do in fact get a bear market. So let's get into it! Now, I want to make it very clear that the reason the markets went down today had nothing to do with Omicron. The real reason the markets went down today is because Senator Manchin rejected the Build Back Better bill. Senator Manchin is a Democrat, and he decided the Senate was not going to pass this bill. Now, that caused the markets to go down on Monday because certain sectors of the economy would have benefited from this bill, especially sectors like EVs, which would have gotten incentives to help consumers buy more EV cars. And so that's why the markets went down today. It had nothing to do with Omicron worries. It had to do with the Build Back Better bill getting rejected. Now, that's a really good news for an upcoming Santa rally, because that means that the downturn in the market on Monday was a one-day downturn, and we can rebound from it and go into our Santa rally, which historically starts about 7 to 8 days before the end of the trading year, which means Tuesday or Wednesday in this particular calendar year. So that's why I think we are in fact going to get that Santa rally starting on Tuesday that will take us up through the end of the year, up until December 31st. December 31st should be a down day, but other than that, we should get the Santa rally through the next 2 weeks. Now, getting back to the Build Back Better bill for a minute, I want to explain why Manchin rejected it. He had concerns over inflation and debt. Manchin essentially decided that while this would be good for social programs, it would actually hurt the economy. Now, where have we heard of a country taking money from capitalists and putting it into social programs? Oh yeah, that's right. China did that just a few months ago. And the net result was that China's economy collapsed. We already saw the Evergrande collapse. Now we see a slowdown in their GDP overall. And it makes a lot of sense. When you take money away from companies that are increasing GDP and you put it into social programs, you're going to take a huge hit to your country's GDP and ultimately a huge hit to your country's economy. So while the Build Back Better plan getting rejected is a bad thing for the stock market because certain stocks would have benefited from it, it's actually a good thing from the economy, and you just have to go look at China to understand why. Okay, now I want to switch gears for a minute, and I want to show you just how bad the market could get in 2022 if we do in fact enter a bear market. Now, before I show you these numbers, it's very important to understand that the United States got on a fiat currency system in the early 1970s. It was around the early 1970s where the Federal Reserve was created and the United States got off of the gold standard. So as I am about to show you the historical GDP, the historical unemployment numbers, the historical inflation numbers, as well as how all of that relates to the federal funds rate, it's really important to understand that this was all in the very early stages of the Fed, and a lot has changed since then. Regardless, this is a really good history example to show you just how bad things could get if we don't get inflation under control. So I want to start by going back to 1973. In 1973, the GDP was 5.6%, unemployment was 4.9%, and inflation was 6.2%. These are almost the exact same numbers that we are seeing right now in the economy. Now, at that time, the federal funds rate was 6%, and it quickly grew to 11% by August of that year. Now, it's an interesting note that in August of that year, there was an OPEC embargo which caused inflation to skyrocket, especially on oil prices. It should be noted that right now, oil prices are sky high, and they are so high that the president is actually considering releasing some of the United States federal oil reserves in order to lower oil prices. So it's a very similar situation, kind of, as far as oil prices back in the 1970s and what we have going on right now. Now, it should also be noted that things did not get better right away. In fact, in 1974, employment jumped to 7.2% and inflation jumped to 11% as GDP dropped to negative 0.5%. That caused a full-on recession in the economy, and eventually that caused the Fed to have to lower interest rates in order to get us out of a recession. Now, the important takeaway here is that as the Fed raises interest rates in order to starve off higher inflation, this could actually lead to a recession if the interest rates get so high due to trying to stop hyperinflation that it causes people to stop buying houses, stop buying stocks, stop investing in the economy, and ultimately that stoppage of buying leads to companies stopping hiring and profits going down and just overall GDP going down. So it's really, really important to understand that if the Fed raises interest rates too aggressively, we could enter into a recession. And if the Fed raises interest rates not enough, we could end up with a situation of hyperinflation. So it's a very difficult tightrope that the Fed is going to have to walk. And it's why we have these vastly differing opinions right now between different economists as far as what's going to happen in 2022, with some seeing deflation and others seeing a full-on depression, and then of course everywhere in between. Now, the next thing that I want to show you is just how bad it could get if inflation continues to run out of control and the Fed doesn't raise interest rates fast enough. And for that, we're going to look at the time period starting in 1978, where inflation was around 7.6%. As you can see, the Fed started raising interest rates. That continued through 1979 as the Fed continued to raise interest rates, and interest rates finally topped out in 1980 at 20%. Now, it's also interesting to note that inflation topped out at 14.2%, and that was also the point where a recession began. And so once again, just like we had seen about 5 years earlier, the Fed decides to lower interest rates in order to end the recession, and that does in fact become successful. However, inflation starts to rise up again, and by December of 1980, we see the interest rates back up to 20% again. Then again, in May of 1981, a recession begins a second time as the Fed funds rate enters 20% territory a second time. And once again, they had to lower the interest rates into 1982 in order to end the recession. So we see this historical pattern over and over again of high inflation leading the Fed to raise interest rates. Eventually, they raise interest rates to the point where that causes a recession, and then the Fed has to lower interest rates. So the question is, what does this do to the stock market? Well, it's really hard to find really good data going back that far since we are talking, 40 years ago. But I do want to go look at the Dow Jones Industrial Average and see kind of what that did during that time period from the 1970s through the 1980s. And what we can see is that the Dow Jones Industrial Average topped out in October of 1965 at around $8,400. It didn't bottom until June of 1982 at around $2,300. So during that 17-year bear market, the Dow Jones lost 71% of its value. Now, of course, I don't think we're going to get a 17-year bear market. It just kind of goes to show the worst case scenario of what could happen. But generally speaking, the thing you need to know is when the Fed raises interest rates, the stock market is going to go down. And since the Fed is expected to raise interest rates 3 times or more in 2022, we can absolutely expect the stock market to go down, which means we can absolutely expect a bear market. So some of you guys yesterday had asked me what happened the last time the Fed raised interest rates. There you go. You have it. They were able to slow down inflation, but unfortunately it caused a recession and the stock market went down pretty significantly. Okay, let's get into our stock and crypto picks. For those of you guys who are new to this channel, my name is Stock Curry. I used to work as an analyst for some large investment banks, and now I analyze stocks for you. Every day I spend hours and hours and hours watching all of the top finance channels, and then I consolidate all of their stock picks into a single video. I give you both the cliff notes on their stock picks as well as my analysis on their stock picks. Now, if anything I talk about today piques your interest, make sure you listen to who I say talked about that stock, and then go watch their video to get the full details on what they said. Now, all I ask for putting all of this together for you guys is that you hit that like button, subscribe, and follow the page. And if you're on YouTube, click the bell icon and click all so that you can get notified when I release my next video. In fact, I'll give you 5 seconds to do that right now. Alright, before we get into our stock and crypto picks, I do want to remind you that I'm not a financial advisor. Nothing I talk about today is a recommendation to buy, sell, or hold. These are just my opinions, which may or may not be accurate. Please do your own research before investing in any asset. If you're wondering what you're looking at right now, this is the Webull desktop app. Webull is the app that I use for my trading, and it is also the app that I use in all of my videos. If you'd like to get 5 free stocks worth up to $8,300, you can sign up for Webull using my link in the description below. When you sign up for Webull using my link in the description below and deposit just $1, Webull is going to send you 5 free stocks worth up to $8,300. All right, let's get into today's stock and crypto picks. And first up is HNST. This is Honest Company. They're an ethical consumer goods company founded by Jessica Alba. Jeremy with financial education said he bought another 11,111 shares at $7.49 on Monday. Jeremy does not think HNST will go down much lower, but the technicals paint a different picture. HNST has been a falling knife ever since it IPO'd back in May. Now that said, fundamentally, HNST is getting cheap. The price to sales ratio is down to 2.24. A price to sales ratio below 3 is considered a value stock, with a price to sales ratio of 1 considered very cheap and undervalued. Of course, with a price to sales ratio of 2.24, HNST would have to drop another 60% down to $3.33 before it would be considered undervalued. Just keep in mind, though, that high growth stocks like HNST typically trade with a price to sales ratio of 15. So from a high growth stock perspective, Jeremy with financial education is right that HNST is cheap right now from a fundamental perspective. But from a technical perspective, HNST could continue falling. So I would wait for HNST to bottom out and show signs of a rebound before buying in. Now long term, there are 9 analysts covering HNST, and the average 1-year analyst price target from those 9 analysts is $12, which represents a 60% upside from Monday's closing price. Next up is TSLA. This is Tesla, and they're an American EV manufacturer. All EVs dropped on Monday after the Build Back Better bill was shot down by the Senate. That bill would have provided incentives for the purchase of EVs, but what's interesting is that Tesla would not have been included in those incentives. And in fact, incentives ended for Tesla vehicles a few years ago. So Tesla should not have dropped today due to the bill, but it did anyway, just due to EVs overall dropping. And because of that, Larry Jones bought more TSLA on Monday. Personally, though, I think buying in on Monday was a little bit too early. TSLA closed below the 100-day EMA on Monday, and all of the technicals remain bearish. I still think TSLA will drop down to the long-term trend line in the low 800s before bottoming out. And it looks like that point will coincide with the 200-day EMA hitting the long-term trend line at the same time the RSI becomes oversold. So once that does happen, we will have 3 indicators that TSLA will have bottomed out. At the rate TSLA is dropping, I do expect it to bottom out this week or next week and then start a new bull run in January. Alright, I hope you enjoyed this video and got a lot out of it. Comment down below what you think the stock market is going to do in 2022. And remember, if you're looking for a broker to trade with, you have 2 days left to sign up for Webull and deposit $1 and get 5 free stocks worth up to $8,300. Again, you only have 2 days left to do that, and you need to make sure that that deposit is in by the 23rd. So really, you only have 1 day left. So sign up for Webull using my link in the description below, deposit $1, and you will get 5 free stocks worth up to $8,300. All right, if you're not a U.S. resident or if you're looking to trade OTC penny stocks, then I recommend Interactive Brokers. Now, Interactive Brokers is a great trading platform. They have highly discounted trading throughout the world. Trades start at just $1 US, $1 Canadian dollar, 4 euros, or 6 Australian dollars, depending upon where you live. And of course, both Webull and Interactive Brokers both offer the full pre-market and after-hours trading from 4 a.m. until 8 p.m. Eastern Time. Now, I do want to remind you that I have material connections with both of those, so whenever you sign up for either one, not only are you getting a great broker to trade with, you're also helping me to continue to produce these great videos for you. I hope you have a lot of success trading, and I will see you tomorrow.